Hi, guys, and welcome back to what is going to be the second last What's on Your Mind that we do ever. We're going to do the last episode, being episode 100 in a couple of weeks' time. Now, the reason we're doing that is basically the show's been going 3.5 years now. The Institute has grown a lot in that time, and we're reorganizing some things internally. And we're going to let you guys know what that means for our free YouTube content going forward. So stay tuned for that. Now, back to the episode. I've got Ed, Shek and Raj Malhotra joining me today. Guys, it's always a pleasure to have you on. It's our final outing together on the show, so let's make it a good one. And Raj, why don't we start with you today?
Excellent. Well, it's been great for working with both of you in this, and for everybody who's watching. I appreciate all your support and all the lovely comments you've made over the years. So with that, I'm going to try and be very positive on this last call. Let's start out with one view that I've had for a while that I've been a little bit shy to mention because it was so out of consensus, but it's been shocking to many, but not necessarily to me, that how well Europe has held up versus the U.S. and the rest of the developed markets for the last 3 to 6 months. And looking forward, I still continue to have that view. I'm not necessarily bearish the U.S., but I just see more risks as opposed to Europe. If you look through our earnings seasons here, Europe's the only region where earnings revisions are actually in positive territory. And as you can see, this is this chart here. That's the main reason for Europe's outperformance. To me, what this has been going backwards, it's been a classic case of under promising and over delivering. Markets clearly shoot over in both ways, to the upside and downside. And clearly, looking backwards, it was clearly a overreaction, mostly the geopolitics, mostly involving Russia, Ukraine. While the market seemed to forget that the China reopening was much more of a tailwind to Europe than it was to the U.S. and some other parts of the world. So, like I said, this is what has been going on in my mind. It was kind of a look at it and set and forget it. The last 3 to 6 months, and while I was a little early on that, going forward, the positive fundamentals are somewhat encouraging. There are concerns of mine that maybe the big move is already in, but I feel it's a little bit safer here going forward. Looking at a few things that one thing is investor sentiment is actually become much less negative in Europe in the last couple of months. I mean, I admit it gives me a little bit pause every time you see a German very positive in the world. That makes me a little scared. But as you can see in this chart here, what's important to look at at any time, the equity risk premium. The equity risk premium in Europe is it's now at its lowest since 2010. Having said that, it's still well above the U.S. And to me, that makes it a much better relative bet, along with some of the other fundamentals that I just mentioned. As you can see, it peaked here in 2011 and 2020. And the equity risk premium in Europe was about 200 basis points higher than it is today. Having said that, it's still 250 basis points higher than in the US. So, something's got to give there. One could argue that maybe with the higher move in equities and higher inflation, this could be a prelude for many Europeans to shift some of their exposure from European equities to bonds, similar to what the narrative was in the U.S. the last couple months at the end of the year. Having said that, I think that is less likely, especially when you also consider the Fed's move yesterday and where I expect the terminal rate of the ECB to be. In fact, if I'm looking at my data, I'm expecting a total of 75 basis points in the next 2 meetings and then a pause. Around 3.25, that would leave ECB rates 2% or higher if you look at where Fed funds futures are now. So I don't think that rate of 3.25 is consensus right now. And like I said, I think there is some positives going forward. I will present a long idea of a European company shortly after I hand it over to my colleague Ed. Since it's second to last, it says last what's on your mind. I want to hear what he has to say.
Oh, thanks very much, Raj. It's an interesting point about the relative valuations. It ties into one of a potential headwind that's sort of in the back of the US market. And that's the end of obviously the TINA trade. You know, there is no alternative to equities and risk assets. Well, I think there certainly is. And obviously, Raj's looking at the relative valuations of different geographies. I mean, the US market's resilience in light of where bonds are is quite noteworthy. And we've gone through another set of earnings when earnings have not been particularly good, guidance has not been particularly good, margins are declining, earnings estimates I still think are too optimistic. But there's just complete seller fatigue. And I think one of the reasons why the cracks in the economy are still being covered is still the ample liquidity that is still in the market. So despite the fact that we're told that things are tightening, they're not really tightening fast enough, right? You know, the bond market volatility is abating, the repo market is deep and liquid. Commercial banks have got $600 billion of excess reserves over their regulatory requirements. Although the lower income market's struggling, in middle and upper middle and rich folk, there's plenty of money still around. So I think we're in this position where whilst we can say, look how strong the market is considering where rates are, and whilst I acknowledge, it's quite funny, you know, Fed's very dovish in January, and now they're very hawkish in March, and now we're going to get jobs data. My personal view is that the economy isn't as strong as it really appears. And without getting into the structure of the jobs created, I think the market can definitely soften in terms of its hotness. And we could see a bit of relief in rates. And it feels like the market wants to rally. But the problem that I have in the medium term is corporate profitability is not really moving up. And I don't see a clear pathway for that. And then coming back to there is an alternative. Money markets are offering good rates. First time in 20 years, you know, the fixed income market might be giving you a better return than a 60-40. I think there are potentially signs that behind the scenes in the big asset allocation moves, it might be quite negative for US equities. But we are left with what we're left with. We've got a market that's waiting for yet another earnings cycle to see if corporate profitability is improving. But there's no real quantitative evidence that it is. And we're left with a very strong jobs data print in January, which will probably get revised down. And then February starts to normalize. And this whole strength in the US economy, I think, could start to look quite different in the foreseeable future. But I still suspect that the market wants to rally on bond yields coming down. And I'm just still trying to maintain a focus on corporate profitability, margins, operational models, and just build my portfolio around earnings rather than the macro or even the bigger macro forces running in the background.
How does that kind of tie into an idea, Ed? What are you looking at?
Well, the first idea I'm going to talk about is symbiotic. The ticker is SYM, industrial machinery. It's a long idea, $10 billion stock trading at about 17.5. Now, this is AI-enabled robotics, right? Automation technology. I'm not buying this because it's got AI somewhere in the title, right? It's trading extremely volatile in a volatile fashion at the moment. Last 2 days, it's been up 10% and down 10%. It's trading like a real loss-making speculative AI, but this is a proper business. So this is end-to-end technology solutions that improve supply chain operations. They've been doing this for about 17 years. It only went public through a SPAC last year. So this is proprietary software and hardware that optimizes bot traffic, storage, lifts, and cells. Without getting into the technicals, we're just talking about AI-driven automation of warehouses. This is clearly the future of all supply chain management. It has huge benefits. It's dramatically increasing efficiency and reducing costs. So from a sectoral tailwind, clearly we're in the right place. Okay. It's got quite a good competitive moat. It's got 400 patents, 100 pending, 250 on board, proprietary software. It really does the whole shebang, and it is market leader. Now, their first client was C&S Wholesale Grocers, the largest US wholesale distributor of groceries. Their clients also include Albertsons, which is obviously the third largest supermarket chain by value. And most importantly, they've got embedded in Walmart. Okay. Now, they've just signed an 8-year deal to supply the automation process to the entire distribution network of Walmart. Okay. So this is market-leading technology that's happening now. It has been loss-making, but the quants are starting to change, and they're doing one thing, which is really the catalyst for why I buy the stock now. Okay. Now, this is a 1 billion revenue stock a year at the moment. It's growing 60% this year, 60% next. Still losing money at the moment. And when we think about their long-term strategy, they're in with Albertsons, C&S, and Walmart. They're really increasing their existing penetration with these big clients. They've signed they've got a $12 billion backlog. All right, most of that is Walmart. Okay, so they've got a big runway with their existing clients, who are clearly some of the most important trend-setting, important retailers in the US market. They are winning lots of new customers, but they've got a real execution problem. Part of this is due to Walmart. Okay, they're doing $1 billion revenue a year, and they've got a $12 billion backlog. All right, they clearly cannot install, make, and supply to meet anywhere near their demand. So clearly, this can expand to many different verticals: general merchandise, obviously apparel, home improvement, auto parts. They can add new verticals, they can add new geographies, and they can expand their product suite. When they break down the benefits of their product to a customer, they think on a customer net spend of $50 million, this is on their observable past, their current execution, it's saving the client about $10 million a year. Okay, this is on a $50 million investment. And they say, and this could be slightly, exaggerated, a shelf life of 25 years for their deployment. So this is hugely accretive for their clients. This is state-of-the-art, proprietary, patent protected, and clearly, if they're driving Walmart's sort of transition to the new world of not having so much human labor, they have no breakages. They don't have lost inventory. They turn stuff around quicker. They can stack things higher. It's just a seamless transition that's unbelievably efficient. So we think they've got a really, really big runway. Now, when we look at the quants, it's loss-making. All right, they've just reported Q1 2023. Its price to sales is 10, falling to 6 next year. Now, what's encouraging is on their last earnings call, the company said that their cash position is now at the low water mark. So the company going forward is going to start being free cash flow positive. They've got enough money to execute the next 18 months of their strategy. Okay. I don't want to get too much more into the quants per se, but just one other thing in the qualitatives. Last year, they've only recorded 6 system deployments. That's in the whole year. And going forward, they're only looking for 2 extra deployments a year. This is a company that is massively capacity constrained. So we know they've got a great market-leading product, huge backlog. They're embedded with the right clients, structural tailwind. We know why people are doing this, and we know that online shopping trends will be broadly supportive. So the limiting factor is manufacturing and installing. Now, what the company is doing at the moment is really building a much bigger base of outsourcing partners. So for me, this is all about execution. They've got to build more stuff. They've got to have more people who can fit their stuff. And this is where the earnings leverage is going to come through. So Much like a previous idea of impinge that's got more demand than supply, it's all about scaling your production capabilities, having an army of people who can go into clients and make this a reality. And they're doing that. And they've got the capital to do that. They've been a bit light on detail, but now the outsourcing partners are looking to span the full deployment process from manufacturing and installation. So this is what's really going to drive earnings. So yes, we know they've got $10 billion of business with Walmart. That's going to take years, right? Are they going to be losing potentially new clients who have to wait 2 or 3 years? So this is going to be management's only focus. They've got to make more, they've got to make them quicker, get scale, get costs down. That's going to shorten the time for deployment, opening up new pathways for new clients. And that's really it. Very, very simple. So this has got nothing to do with everything to do with AI. This is about, they've come through, their pipeline shows this is a product that they want, their cash position's okay and getting better, and they're going to be working 24 hours to expand the supply chain for their business. In terms of structure, next earnings are on May the 9th. I've got an aggressive price target of 25. I think that's probably a bit too high, but they're clearly not going to be able to announce that they've got all these partners, productions online. They need to really show progress. They need to actually give some detail. So this is a stock that I can imagine if the management executes, that I might be able to stay in for quite a while. This is a company that could grow multiple times over the next 3 or 4 years. So if you bought the May 17.5 and sold the May 25, you could get 24 spreads on for under $5,000. Up to the high price target of 25 will give you just under a 3-for-1. Now, I'll be happy if obviously I want the stock to rally. 25 is quite an aggressive price target. So this is really the beginning of what I hope will be a tradable situation. And that's symbiotic, SYM.
Awesome, good stuff, Ed. Let's go back to you, Raj. You were talking earlier about some macro, and you were kind of thinking about relative valuations. Does your idea tie into that?
Yeah, it actually does. One thing I wanted to mention, one anecdote from what Ed was talking about in terms of the high-end consumer, low-end. In terms of housing right now, I've been actually looking, for a house, and there are no. There's no supply. Everything is still a bidding war. So there's not a bear market, at least in existing home sales right now. So it's just something that that's kind of a point that Ed made earlier about where the pain is in the U.S. Consumer, and it's certainly not at the medium to high end yet. So just keep that in mind. Anyway, back to what I was talking about. So yeah, one idea that I have is it's a big, boring Spanish bank. If you remember though, from my last What's on Your Mind, I've become a lot more boring in my older age, and boring can be good. So the bank is Santander, SAN. If you look at their last earnings, wasn't really anything to write home about. But again, I think it was the fact of lower expectations, beating that. But to me, what was more important to this company, and really a lot of companies look at, it's what they were signaling to the market, and was really interesting. So let's go through the basics of the company first. The stock is trading a little, just around $4 a share. The market cap's around 67 billion, a little higher than my normal names, but I do think this one's got a lot of upside from here. The PE is just around 7, which is very low compared to peers. And the dividend yield, I'll cover that a little bit later because I think that's a very important point on that, and I want to touch on in terms of the important stuff. If you look at their last earnings report, their earnings per share and revenue all are pretty much in line. Now, while those numbers at first look like there's nothing to see here, what's important is they actually delivered record profits in 2022 of 2.3 billion euros, and their earnings per share actually grew 23%, and the revenue grew 12% year over year. So in a given the expectations of how Europe was going to collapse in 2022, and it was basically the end of Europe. These numbers are very impressive, given what expectations are, and in my mind, there's a lot more to come. If you look at the recent performance of the stock, the stock's up 35% year to date already, and up about 45% in the last 6 months, kind of a little bit after it hit my radar. And I think it's got a lot of room to run, and I'm going to give you some reasons why it'll continue. So, in my opinion, not many European banks. I mean, a lot of European banks actually entered fair value. I've been bullish on the sector, but Santander is different. Spanish banks traditionally traded at a discount to the rest of Europe, probably due to the general disbelief in Spain and historically how Spain has underperformed. But I think what the market's missing a lot is Santander is not. It's a global bank, even though they're based in the Iberian Peninsula, and they clearly have a lot of business there. They've got great loan exposure to the rest of the EU, the rest of the in the US as well, and the UK and Latin America. Another thing about Santander is that's not understood. Santander, unlike a lot of the Spanish companies, they've got a great risk culture. I remember back when I was at B of A, as they were a counterparty, they were always a very solid bank in terms of their risk culture. I knew the trader there, and they handled the financial crisis very well. So on a historical perspective, they've always been good at managing risk, and going forward, nothing has changed. So if you look at some of their loan exposure, they actually are they're actually giving a lot of loans to a lot of ESG type financing. Now, while that might scare people like me and be happy for the woke traders, if you look at their historical loan default rate, they're a very conservative bank. And again, I don't think that's a negative. In fact, I think it's a positive, given that is a growth area of the world. But they're focusing on the higher end and the companies that will survive and that actually will be able to pay them back, versus some of the lower quality companies in the sector. If you look at some recent catalysts, they announced that they planned to return half of its profits over the next 3 years to their shareholders in either higher dividends or buybacks. That's obviously pretty good as an investor. The CEO said he wants to return 15 to 17% of tangible equity back to shareholders. So while that's good in the short run, I think there's still a lot of room to run in the long term versus other European banks. If you look at the past performance, it's up only 14% in the last 3 years, while the Euro Stoxx Bank Index is up 55%. The CEO also announced that they're planning to looking at add 40 million customers over the next 3 years, and adding products and services to them. So one thing I like to look at is the comps. Now, this is admittedly, this chart here, it's a year old, but the bank has basically the same total number of assets as Wells Fargo. And as you know, Wells Fargo has had all kinds of scandals and trades a significant discount to the rest of its U.S. peers. So you can argue Wells Fargo is, cheaper than most of the big U.S. banks. But if you compare Santander to Wells Fargo has a $180 billion market cap, which is 2.5 times Santander. So again, I'm not saying to go out and short Wells Fargo or the rest of the U.S. banks, but I'm saying that Santander clearly has room to catch up. Another comp, if you look at the U.S. Bancorp, so that company has about a 1/3 of the total assets of Santander. And their market cap is $72 billion, which is slightly higher than Santander. So again, there's room to catch up here, and Santander is just cheap on this relative basis. Another thing that, in terms of my big European versus U.S. call, it seems to be a consensus now that the U.S. is going to go into a recession later in 2023, early 2024, and Europe is no longer a consensus view to go into recession. So if you compare U.S. Bancorp again to the Santander with those two metrics, Santander probably looks cheaper and should do better on a relative basis just in the next 6 to 12 months. So In terms of price target, I think this company can easily rally another 50% and get to a $100 billion market cap for an A+ rated bank. And again, it's not just a strictly Spanish bank, and it's very global. And I'd rather have exposure to the global market right now rather than concentrated just to the U.S. And whether it's with a big dividend increase, which could certainly happen, earnings growth when this company, which could happen, multiple expansion. Again, the stock is trading the sub 7 PE. There are lots of ways for the stock to rally. So whether it's a long-term investment or an outright trade or a pairs trade in another bank, I suggest you don't take a siesta on Santander. So in terms of trade structure, I'm looking at two options that are relatively low risk and high reward to me. If you look at out to just the June 4 strike calls, which again, stocks at the money, they're trading for about 25 cents. Or even, you probably need a little more time, maybe out to SEP. Those are only trading for 35 cents. The stock goes to $6 in June. They'll make 7 times your money. Even if it takes longer out to SEP, they'll make close to 5 times your money. Again, this is to me, this is a trade with little downside and potential upside if the market does what I expect it to do or what it should do.
Yeah. Nice.
Ed, go on.
Yeah, I like the idea a lot. And, the way that these European banks can trade, they can sometimes trade like super tankers. They get a bit of momentum and they've just got nothing spectacular. But before you know it, they put in a decent move. And this stock's been rallying from 2.5 level as recently as October. It's already at 4. And as you say, there's nothing on the quants that's going to worry you. So it could be just a nice grinder and it's putting in some big moves, although it tends to happen a bit under the radar, doesn't it, Raj?
Yeah, absolutely.
It just doesn't grab the headlines. It's all just banking and, valuation expansion and the removal of discounts. It can just happen quietly. I really like it. Nice one.
And again, it's value versus growth, right? When things break down, especially with yields higher here, you're looking for value. Value is that should be in favor going forward, and this is clearly value has some value, hopefully.
Very nice, very nice. So I've got one other stock to mention. Now, this isn't value. This is a little stock called Elf Beauty. Personal products, basically makeup and skincare, consumer staples. Now, this isn't one to buy today, but I wanted to outline it because it's a really high momentum stock at the moment and the company is really firing on all cylinders. It's a $4 billion company, about $75 a share. And it's a multi-brand beauty company and it offers cruelty-free cosmetics. So the way they pitch themselves is premium quality at a very low entry price, broad appeal, vegan, meaning cruelty-free, no animals, fair trade certified. It's got 4 brands: Elf Cosmetics, which is really colour makeup, and then Elf Skin, Well People, and Keys Soul Care. Now, it distributes its products through national retailers, big box outlets. So it's primary through the mass drugstore, specialty, and retail channels. So Walmart is 26% of their sales. Target is 23%. They're the number 1 seller at Target. Ulta Beauty, 12%. They've also got relationships with CVS and Walgreens. Internationally, they only sell into Canada, Australia, UK, and Germany. It's only 13% of sales, but they're growing at 80% on a year-over-year basis. And they also have their online channels. So this is direct to consumer. Again, only 15%, but that's growing at 75%. And they make and source all their materials and manufacturing in China, which is obviously going to play into this at some point. Now, they've got a very interesting business model. No TV, no print. This is social media. This is influencers. This is TikTok, Twitter, Instagram, Facebook, YouTube. But they're very big on TikTok. Now, this is relatively low priced for media savvy younger generation. They've gone after Gen Z and they've got Gen Z. Huge penetration. and that's running at steady levels. However, they're now starting to see really improved trends in Gen X and millennials. Now, this could be for a number of reasons. Firstly, people are looking for value, right? Consumer spending is under pressure with the lower and lower middle. So what you might used to spend $60 for Estee Lauder, as an example, you might be funneling into a quality product that's at a much cheaper price point. So the trends for their lower penetration demographics are really improving. They've got 3.5 million members in their Beauty Squad loyalty program, right? So they're doing really well. They're smashing revenue, smashing earnings. They've got pricing power. Their margins are going up. This is all in the environment that we're in. And that's the advantage of having a lower price point. Easier to go from $8 to $9 than it is to go from 60 to 70. Okay, and they're seeing that. But they are a fast follower business model, much like fast fashion. So not quite ripping stuff off, but pretty close. So what they'll do, and they've mentioned this on their earnings call, is they will spot a foundation from a prestige label, and it's selling really well, and it's $60 or whatever. And they will give it a twist, they'll brand it, they'll market it, they'll manufacture it, and it's in the big retailers in a very short time, and it's priced at $8. And in this example they gave, they sell 9 times as many units as the original. So this is their model, okay? It's extremely effective. And when you look at the quants, they're just smashing numbers. But of course, it's now trading on 50 times this year, falling to 47 times. This is not a value stock, okay? Just to give you a bit of comparison, though, if you look at something like Estee Lauder, it's trading on a forward PE next year of 33.5 times. Elf's on 47 times. But when you look at what this stock's done in the last 2 years, it's doubled its revenue and its earnings have gone up more than 2 times. Estee Lauder, their earnings are flat over 2 years. Their revenue's gone up 5. So whether this is it's not that expensive relative to Estee Lauder, or you want to put on a pair trade, I'm not really covering Estee Lauder today. It's expensive, but the growth justifies it. Now, the only reason you buy it today is if you think they're going to continue to beat earnings. So that 2023 is going to be a banner year. They're forecasted to grow revenue and earnings by another 15% going into 2024. You don't buy it if they're going to meet those expectations. You only buy it if you think they're going to smash it and guide up. So when we look at their business, when we look at their color makeup category, it's growing at 8%. The sector's growing at 8%. Elf Cosmetics growing at 36%, right? They're basically getting 7% of the entire market now. But when you look at other products, and they're very innovative, they do very poorly in mascara, lips, and skincare. They only have 1% of the total dollar spend. So I would always want to back a management team that's smashing it, and it can move into other areas. Okay, they've got the distribution network, they've got the coolness in social media. So I see a real path for expanded revenue growth and earnings growth coming in the other product categories. Okay, when you look at their current market share gains, if you look at the top 5, that's L'Oreal, Maybelline, CoverGirl, and Revlon. They've taken 1.5 points of market share in the overall market. They're really, really making inroads, okay? They've got strong momentum and they've still got big runways with millennials and Gen Z as they look for lower price points. So to conclude with the catalysts, they're already number 1 with Target, but they've got a big runway with Walmart. So one of their key KPIs is white space, shelf space. So it's gone up a factor of 10 over the last, 6 years. And they're still growing rapidly in Walmart. A lot of this is getting your product in the right places in front of the right customers. So I think they've still got a really big runway with their existing big core partners. All right. International expansion, it's still very small. So I should imagine this is going to be a real source of growth going forward. All right. Certainly in certain parts of, like Australia, Canada, and certain parts of Europe. Okay. Now, why wouldn't I buy it today? Now, this stock has had a big move, as I said. All right. It's up 85% since October, 27% year to date. Now, I'm going to mention quickly the risks. The risk is it's obviously very social media influenced and it's very cool, but obviously the life cycle of these brands can be much faster now, and there's always a chance something cooler comes along. Part of their appeal is their ethical stand, but at the same time, it is a low-cost product manufactured in China. So there's always that risk, a reputational risk, someone finds some photos in a factory or it's not as ethical as you think. That would be pretty devastating. But the reason why I would wait till after March is, firstly, the stock's had a big rally. Secondly, on the 23rd of March, the CEO of TikTok is doing his congressional hearing. Now, TikTok is a political minefield. I've got no view on what restrictions might happen or when, or whether it gets banned. What I would certainly wait is for this congressional hearing to go. And if it leads to a big sell-off on some hawkish TikTok-related commentary, I would use that as a buying opportunity for this stock. So as much as I can look at the quants and think it's a bit expensive, I'm just always thinking about how's it going to continue to be? Are there any levers? It's got pricing power. It's got demographics with strong momentum outside of Gen Z. It's got big white shelf space gains to come. Their product mix is improving, and they are very innovative, which makes me think they can break into the lips and mascara to the same level as their color. So I think the operating model is great. It's obviously got a bit of TikTok risk, right? And one has to be, aware of the risks of fleeting social media hotness, so to speak. So I would try and buy this on weakness following the 23rd. If not, all I would do is buy a June 70, sell a March, well, I've missed March, sell an April 75. It's got to be quite at the money because the stock's had a big rally. The only way you get a really decent return is if you can collect credits along the way, then sell the May 80s, hopefully end up in the June 85s. By that time, if your initial £5,000 net spend would have been reduced by a couple of credits for a couple of grand. So at that point, your returns are really changing on your structure. You've spent 5, collected 2 credits, got 3 left, and that could still make 10 if it got there after earnings. And that's Elf Beauty.
Good stuff. Well, gents, we're going to finish up there. That was your final episode of What's on Your Mind. You smashed it, Raj.
I think since our final episode, can we please see Sheki's TikTok makeup video for our viewers? I think that would be a great way to send this off.
Yeah, that will be coming. That will be coming.
I think that will get more views than this ever has.
All right, good stuff. Yeah, as always, content was fantastic, guys. So much to learn from both of you, for all of us listening. I want to say thanks to both of you for the episode, but also for all your contributions over the years on What's on Your Mind as well. It's been great to have you. So for all of you watching, there's 3 things that I quickly want to mention before we close the show today. The first one is for those of you that are first timers. That's those that haven't subscribed to any content with ITPM. Make sure you sign up to our free global webinars, okay? You can see those listed on our website, itpm.com. And also, if you're interested in our educational courses, they are up there as well. Secondly, if you're ITPM alumni, then we've just launched our ITPM alumni Discord server called Study Hall. It's going really well. If you haven't heard about that and you want to sign up and be a part of that, then make sure you send an inquiry form in on the website. It's providing loads of value already to people that are in there, and it only started about a week ago. Equally, if you guys want to push yourselves further than the courses that you've already consumed with us, we've got mentoring programs as a reminder. You can sign up to those on our website as well. And then finally, to those of you that are mentees, I think you will have all heard about our society Discord by now, but if you haven't, that's the Discord server for you, okay? It's the sort of premium offering that we have for you guys to stay in touch with mentors and learn from them outside of mentoring programs themselves. And it's providing absolutely epic value. The community in that server is fantastic. That's been going for a bit longer, and it's really proven its worth to everyone that's in there. So yeah, that's all I wanted to say today. And yeah, I'll see you guys next time for the final episode of What's on Your Mind.